Speaking of earnings, David, buckle up for next week, I guess, because the banks are on their way. And luckily, we'll have Jim back to talk about it. But a couple of interesting calls on Wells today, right? Evercore adds it to the tactical outperform list. Baird goes to outperform, as there's this notion that at least when it comes to Wells, if they rip the Band-Aid off, so to speak, as I think it was Evercore said, maybe that does tactically outperform. But next week's going to be wild.
It is. And the banks, I mean, Mike mentioned, of course, what we're seeing in terms of yields right now. That's not a great formula for success for the banks. We've talked about some of the banks benefiting from the incredible amount of activity we've seen in debt and equity capital markets. I think there's no doubt you're going to see numbers there that are extraordinarily strong. Merger and acquisition activity, as people well know, has not been. That has been muted. And then to the overall interest rate picture and their ability to actually maintain or have a net interest margin that is significant, that is going to be under pressure. And that's why we're seeing so many of these names. And you mentioned Wells Fargo. We've watched the weakness in that stock. We watched a rebound as well, Mike, for some time, but it is yet again below $100 billion market value. No shortage of challenges for Charlie Scharf, although they do seem at least to have answered the dividend question, perhaps not in the way that some had hoped, but they did answer it there. And so I guess we'll just have to wait and see what more we get from them in terms of earnings and outlook.
Yeah, I mean, it's really remarkable that it's happening to Wells, which now trades at a discount to book value that looks very much like Citi, whereas Wells used to always have this huge premium to book value. Actually, the group as a whole, the S&P bank sector, is at something like 75% of book value in aggregate. It's basically as cheap, if you believe the stated book values, as it was in 2011 when we had the sovereign debt scare, when yields collapsed. And by the way, everyone thought yields would never go up again for the foreseeable. So, the valuation case is just pretty much all you have right now because everybody has so absorbed all the headwinds. And yes, the capital markets business looks great. Can we extrapolate that forever? Maybe not. Yeah, they took on a lot of fees from PPP loans, but again, that's a one-off too. So it is a really interesting trade. At some point, they just get, the group gets stretched too far below what the rest of the market is trading like. And we'll see if that has, if earnings are some kind of a catalyst for that change. And credit loss is obviously what they say about them in the next couple of weeks, and projecting ahead probably is going to be the big factor that we can't quite model in just yet.